What's up, everybody? Welcome to More Than Mortgage. We are another decade old in episodes with this one, 60. So thanks for hanging out with us a little bit over a year. He's Zach Jones. I'm Chad Anderson. And today we're going to talk about another decade type number. And you're so used to hearing about 30-year mortgages. Well, this is something that's been kicked around a little bit. I believe it's popular over in China, if I'm not mistaken. Maybe it's Japan, maybe it's both, but either way, I'm not an expert on that side of the world. But we're going to talk about 40-year mortgages. Are they realistic? Does the math make sense? Is it a way to clamp down on affordability and get more people a payment option? And some of you may say, oh my God, we're doing 40-year mortgages now. We'll never pay that off. Well, I got a news flash for you. Go through your phone, go through your family tree, go through your friends. How many of them do you know that had a mortgage and made every single payment for 30 years? My answer and guess for you is that it's either zero or it's definitely no more than on one hand.
Very few.
So, yeah. So the point of this, like, oh, we're stretching out debt even further. Like, nobody holds a mortgage for 30 years. They just don't. So, Zach, I asked you this question as kind of a, hey, what do you think about this topic for a show? Because affordability is an issue. We got to get the payments down. We got to figure out how to get people into houses because prices aren't crashing like the FUD people love to do. And it's just not moving the needle. So 40-year mortgages, is that an option? Does the math work? More people would qualify potentially. But when I kind of threw it out there, you actually educated me on the math and kind of shut it down in a hurry, but we thought it'd still be a good topic. But anyway, you had a really good answer. So I'll let you take over on the 40-year here.
Well, as is my custom, I'm going to give a long answer to a short question because I think that the historical perspective, I'm a student of history, and the historical perspective on this is pretty interesting. Back before the mortgage meltdown, there was the situation in the United States was that it was really a buyer's market, it was a buyer's market for several years, and there was way more inventory than we had buyers to buy houses. And so, I can remember back in the early 2005, 2006, before you got in the business, I bet I had 6 or 8 100% loan products of different varieties. Some of them had down payment assistance. There were actually conventional loan programs that allowed 103% loan to value so that you could borrow your closing costs on a conventional loan. So, and there may have been, I'm kind of distant memory of 105% loans too. Those may not have been conventional products, but one of the things that kind of came up in that period of time, in order to further entice people into buying houses, we had lots of incentives all over the place. And oh, by the way, if you wanted to do a 40-year mortgage and get your payment down even further, we'll do a 40-year mortgage. And that was either a Fannie or a Freddie conventional product. May have been both of them came out. And we, were kind of excited. I can remember sitting in the sales meeting at the bank, and we were talking about it, and everybody's like, "Oh, wow, that'll take those payments down significantly." And then we got over to looking at the price sheets, and we literally had pricing sheets back then, and the price sheets came out, and I was like, "Well, wait a minute, let's do the math on that." And the math really didn't work because the interest rate on a 40-year term is going to be higher than on a 30-year term. And so,
and to real quick, to just piggyback on that exact sentence, if you go, well, why would that be? It's the same reason as to why the 15-year is lower than the 30-year. Same thing. The longer the loan period, the riskier it is to investors.
So, to the lender, because they're stuck.
So it's natural. Yep.
And even though the investors also know that nobody ever stays in their loan for 30 or 40 years, but that they do calculate the risk based on that. And so we figured out real quickly that there wasn't enough difference in the payment to make sense out of putting somebody in a 40-year loan versus a 30-year loan. So the math that we did the other day was adding about a half. Maybe we added 0.5% to a a 6% loan at $300,000 and a 6.625%, $300,000, first one on the 30, second one on the 40. There's a $15 difference a month, which is kind of crazy. You think if you extended it out for 10 more years that you'd get a break, but that the increase in the interest rate for the 40-year loan closes that gap back up. And so it's just not a viable option. Now, there was some talk, and maybe it even happened. There was an FHA, a proposal at least, and maybe an implementation of an FHA 40-year term for loan modifications for people that were in trouble on their mortgage. They were going to foreclose. They had a bad, family situational thing that happened, and so they couldn't make their payments. And so FHA was extending a loan modification program, which would be the same rate for 40 years. And maybe think about this. If that person had already been in that house for 10 years in an FHA loan, and then they got in trouble and FHA offered them a modification for a 40-year loan, they only have 20 years left at the same interest rate. Now, that's a big difference in the payment. It would help somebody who was in trouble. Maybe two income went down to one income. They're trying to bridge the gap and get through that hard spot in their life. That's a real benefit, but not in the purchase realm. A 40-year term will never make sense over a 30-year term just because of that increase in the interest rate. And they're not going to probably give you a better interest rate on a 40. I just don't see that happening.
Yeah. So I just did the math real quick on my phone. I should have been better prepared for you anyway. But if you did a 30-year fix, this is not an offer to any of you out there thinking like, oh, Chad quoted this, and so therefore I'm going to hold him to that, or I'm going to turn him into the CFPB. That is not the point here. So that's my disclaimer. All right. If you had a $400,000 loan for 30 years at 6.5%, okay, versus a $400,000 loan for 40 years at 7%. So
Right.
the same 400,000, 6.5% 30 year, 7% 40 year. Difference in monthly payment, $43 a month. Odds are, guys, if you're trying to qualify, we will tell you, pay off this credit card that's got an $800 balance on it with a minimum payment of $35. Let's see if we can find you a homeowner's insurance quote that's barely cheaper.
Right.
Let's just buy down the interest rate an eighth or a quarter of a percent and save it that way. There are so many ways to reduce and get you qualified based on $43 a month that it'll get figured out. That one will close if that's the only difference in you qualifying versus not. $43 a month. So I think a lot of times, like you said, you get 40 years, you think, wow, you start stretching it out, doing this, doing that, and it really doesn't move the needle. I think kind of knee-jerk reaction is everybody would go, oh, that'll save me a couple of $100 a month, put me in a little bit of a different situation.
Right.
And in reality, it's not even close.
So not a viable option. Let's try something else.
So what do you think is viable? I mean, Trump is in here right now throwing out executive orders demanding lower interest rates, going up against the CFPB. He understands, again, like this guy or not, he's worth a lot of money, and he's been in real estate his whole career. So he understands housing. Everybody understands that real estate is the largest sector of the U.S. economy.
Right.
It makes the world go round.
It has to work.
So you have to figure out affordability, and that's the struggle. So do you do 40 years temporarily? Like, do you take what you have, like you talked about, and do you do something in that regard? Again, what would the math look like if you took your current balance that's been paid down? Maybe you already have a lower interest rate. Do you stretch out terms? Do you offer it as incentives for new home buyers? Do you do the tax credits? That was something that Kamala Harris was running on, was these big giant tax credits and refunds and so forth. It's going to be interesting because the whole loop to this episode is that 40 years to some people is the answer. Well, it's really not.
No.
I think another option, Zach, I'm literally spitballing off the cuff here you've got 3 or 4 minutes left, is do you eliminate MIP? Do you eliminate a funding fee? Like I'm talking about FHA loans.
Yeah, you could definitely do that in the FHA system because the FHA system has so much money stacked up. That's
They've got a
another.
huge surplus.
Oh, it's like unbelievably flush with cash, and so
Yeah.
that's a resource. Absolutely, I like that idea.
Well, your MIP is a whole lot more than the 40-year mortgage game.
Right.
Like if you did a $400,000 loan, for example, the standard FHA MIP based on 3.5% down payment comes out to be $2,200 a year. That's $183 a month.
It's 0.5% a year. I mean, there's a 0.5% break right there if you take the MIP off on a FHA loan.
Yeah. So yeah, that could be a possibility.
Yeah.
If you want to ramp up affordability and get some additional people qualified, or just make the purchase or the price more comfortable. Because like we said, the prices aren't coming down. And I've told a handful of people this. I know you've been going through the same. I'm not kidding when I throw this number out there. This is not an exaggeration from a sales guy. I currently have 25 plus families who are pre-approved, who haven't bought a home yet. Like they're literally, and that's within the last 60 days, meaning they're active. These aren't 7-month-old leads that kick the tires. This is the last 60 days. And trying to find something that is in their budget with the interest rates is a challenge, or they either have a house to sell, but they don't want to give up their low rate of 3%. Or the perfect house comes on the market. That's what everybody's waiting on. And I kind of remind everyone, affordability today is a struggle. But at the same time, you look again and it's like, well, if it's a struggle for everyone and we wait on rates to come down, then affordability gets solved. But if it gets solved for the masses, now all of a sudden there's 3 to 4 extra families per house that goes on the market. So I don't know. Again, I like some of these episodes that we do just because it's more like critical thinking, topic for discussion, get people's brains working a little bit. Right. But we've determined with the math, the 40 year is out. Do you have any other, I don't know, like solutions, things you'd like to see, ideas that you've read about that could get kicked around and might be viable?
There are multiple things that I've kind of have on my mind. I think that the standard capital gains exclusion that's been in place for 20 or 22 years now needs to be increased to keep up with, modern prices. There hasn't been an update or an increase to that exclusion limit in over 20 years now. And so I think that that's one piece of it. I've got
you're talking about if you're married, it's 500 grand exempt, right?
Right.
Yeah. So what Zach's talking about is when you sell a home, if it's just you, if it's a single person, an individual, you're exempt on $250,000 of the gains from your cost basis, plus any improvements you made while you lived in the home, had to have lived in it for 2 of the most recent 5 years. And the first 250 you profit after all of that, you're exempt. If you're married, it's $500,000. I agree with what you're saying. That's a lot. Like even if you bought during COVID for 300 and it's worth 600 today, still if you're married is what I mean. Like the 500 is covered. So I like where you're going with it, but I think that's more in a bracket of the luxury real estate and not going to impact their affordability as much unless you got something else on it.
Well, my point about capital gains specifically, and I've got some pet ideas about how capital gains could be manipulated for mom and pop investors who own mom and pop real estate, duplexes and so forth. What I think about that is that it's going to benefit a certain level from that capital gains break, but it's going to shake the tree all the way down to the first-time home buyer, because now real estate is moving. There's another percentage of real estate that's going to move because, there's a break in the capital gains tax. It wasn't as much as it used to be. Now is my time to make a play
Right.
on this. Somebody sells a house, and then there's this chain reaction that happens in the system, because even if it's a $3 million house, that $3 million home buyer is moving out of $1.5 million home, and their buyer is going to be moving out of a $700,000 home, and then that buyer is going to be moving out of $350,000 home. So I like the stimulation.
That's a good point, because I will say this. I had a good run during COVID, and so I looked like a genius, and then I looked like an idiot, all within about 18 months. And I will say what happened is capital gains tax, because we bought and sold so fast, because that's how fast prices were going up, that you take a step back and you go, well, I don't want to pay 35% on the sale of this home. Like that's a lot of money to give up.
A lot of
my
money.
Profit.
Yeah.
I don't want to do that. So real estate's so hot, I'm just going to roll it into the next one. And you kind of keep doing that. And like what Zach is saying, that you're never really cashing out the equity to then shake the tree all the way down. You're constantly holding on. Now, some of you may say, well, the argument is, but you keep buying real estate with that. You do, but with capital gains, you have to keep buying up. You have to keep spending. If the liquidation never enters into the market, then that can become a problem and kind of stall things out. So,
and I'll say this too, Chad. I just want to add this kind of on the tail end of this, is that there's a lot of kind of buzz and talk in the markets about all of the changes that the current administration is engaging. And, you got to realize that Trump comes from a real estate background. So he really does understand the real estate piece of it, and what he's doing, what he could do, the things that he's, pressuring maybe the Treasury and the central bank to do. There's a lot of factors to that. And what we really don't know, you add tariffs on top of that, and, the external revenue service. I mean, there's all these ideas coming at the same time. And I did see an article recently that was published by one of the biggest real estate brokerages in the nation. And they were talking about all these positive projections about how rates were going to slam down in 2025, and the average was going to be this really attractive number. And I'm really reticent about making any investments in that kind of projection, because we've never literally ever been in this situation before. We haven't been in a situation in the modern economy where 2 of the 22 factors that are playing in right now have been in place. I mean, everything is changing. So I think that caution is the watchword. And I also believe that it could just as easily go the other way. I think there's so many things going on. I do believe that these policies will eventually result in a positive shift for Americans in their personal budgets. But in the meantime, are they going to see that in the short term, or is there going to be some, disruption that takes us in the other direction, and we suffer a little bit more for the short term, and then the long-term benefits come in? And I don't know. I think it's anybody's guess. So
all I know is experts have been wrong for 3 straight years on interest rates. So
so wrong, so convincingly wrong. So,
and to wrap it up, in the last 3 years, we have seen rates, really 2.5 years, but we have seen rates dip back down to as low for a conventional as the high 5s, maybe the mid 5s if you were willing to spend a little bit of money, all the way up to the low 8s. Like, that's what we've seen. But we've seen brief snapshots at the ends of each spectrum,
right?
Or the spectrum, each end of it. It's been a brief snapshot. It didn't
stay
in the 8s for long. Yeah, it didn't stay in the 8s for long. It didn't stay in the 5s for long. It's hovered in the 6s and in the low 7s. That's kind of been the general average or the majority of time spent. We'll see. Everybody starts every year hoping that by the end of the year, we're going to see rates back down again. Who knows? All I can say is if affordability is something you can withstand today, you have less competition. And if rates do drop, and we've seen the dips here and there, but just nothing permanent, one, don't look a gift horse in the mouth. That's what happened to everybody back in Q3 and 4 of last year. Take what the market's going to give you, but also just be very aware of how much fire will be stoked by competition once things do kind of trend that direction and show that trend. So
Yep.
we'll see. But all right, next week's episode, mortgage delinquencies. Is that even real? Is it real? Is it something that's actually happening? Or is this just more clickbait? We're going to talk about that. Make sure you follow us on the socials, like, subscribe, hit the bell, download, follow, share, comment, whatever you got. Appreciate it. Mortgage Dad Chad, Zach Jones Loans. And that's 60 in the books. We'll catch you next week.